Welcome to the Greatest Lessons series. I'll highlight the most important lessons taught by Benjamin Graham by using my longer videos to showcase them. This episode is Enterprising Investor Guidelines. And as always, if you enjoy the episode, liking the video, subscribing if you haven't done so already, and hitting the bell for notifications is greatly appreciated. In this, you'll see that there's many ways to make money as an enterprising investor. Benjamin Graham will explain some of the unique opportunities in the market that otherwise aren't obviously seen. So you can make money here, 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 or even here. What you'll notice is that it's similar to the Defensive Investors Guidelines. Most of them are more relaxed suggestions from before because Benjamin Graham is expecting you to be more diligent. And this is also the section where I found the Graham formula, which includes his old formula, which was found in the books, and also the revised formula that I found later for estimating stock value. The video clip will explain why you should be cautious using this, but it is useful for finding stock estimates. Let's watch a short segment of my longer series on Benjamin Graham. Now we get into the enterprising investor, and here are some special cases to make money as an enterprising investor. I'll go over 4 unique circumstances as described by Benjamin Graham. In the first 2, he only puts money in if 1. There's a calculated annual return of at least 20%, and B, the chance of a successful outcome was at least 4 out of 5. In the last 2, he tried to find as many of these as he could. The first of the 4 special cases is arbitrage, second is liquidations, third is related hedges, and fourth was net current asset or bargain issues. Going into number 1, arbitrages. This was one of Graham's favorite ways to make money. And one of the 2 arbitrages is pure arbitrage, buying differences in security costs across different exchanges. People like us likely won't ever be able to do this since there are super powerful computers that can look at this stuff constantly. But back in the day, he had more of an opportunity. So for example, we have one store that says buy our apples for 50 cents each. And we have another store that says we'll buy apples for 51 cents each. Wait a minute. The second of our arbitrages is risk arbitrage, and I'll provide the example of IBM's Red Hat acquisition. The announcement is that IBM was buying Red Hat for $190 per share, equating to about $34 billion. The acquisition possibility made Red Hat's price shoot up dramatically, but you can't really know when these announcements will happen, so you have to make the choices after the fact. If you had confidence that it would go through to completion on the day of the announcement, here would be your returns. About 10.7% return in less than a year. Now, since this doesn't hit Graham's expected 20% minimum, he likely wouldn't have bought it even if he was 80% sure that it would have gone through to completion. The second was liquidations. Buying securities where the assets will be sold off and the cash obtained will be distributed. Going out of business, selling $10 million in assets. I'll have to look at their debt obligations and see if I can make money here. Third is related hedges, and the related hedge is buying and selling different securities from the same company. Benjamin Graham's purchasing time for this was where the position was established at close to a parity basis. He bought convertible preferred shares or bonds and sold the stock soon after converting. I like to exercise my investments. The fourth is the net current asset or bargain issues, comparing the net current assets to the market valuation of the company. This is purely looking at cash and cash equivalents and not attributing to the other assets. Of course, he would be taking the debt obligations into account as well. And he says our purchases were typically at 2/3 or less of such stripped down asset value. In most years, we carried a wide diversification here, at least 100 different companies. I'm selling this ugly bag that has $20 inside. I'll sell it for $15. What? Yes, I'll buy it. Now we can go into stock guidance for the enterprising investor. These are somewhat similar to the defensive investor guidelines, but less restrictive. If you're really an enterprising investor, then I'm assuming that you're doing more research on the well-being and future prospects of the company. The first is the financial condition, part 1. The current assets are at least 1.5 times the current liabilities. If current liabilities are $1 million, then the current assets must be at least, but preferably more, than $1.5 million. The second financial condition, part 2, is that the debt must not be more than 110% net current assets with industrial companies. If net current assets are $1 million, then debt can't go past $1.1 million, but it's obviously preferably less. The third is earnings stability. No decrease in earnings for the most recent 5 years. 9% growth, 7% growth, 15% growth, 10% decline in year 4, but then it rebounds 17% in year 5. Even though it rebounded, it still declined in year 4, so it makes it not a good choice according to Benjamin Graham. The fourth is the dividend record. Some current dividend. Yeah, even as an enterprising investor, I love dividends. Then we have the earnings growth. Minimum increase of at least 1/3 in per share earnings in the past 10 years, using the 3-year averages to calculate the beginning and end points. I'm just a slow company. No snails here either. Now we can get into the price to earnings ratios for common stocks for the enterprising investor, where he says exact appraisals are not possible. Security analysis can't lay down a formula or set number to give the intrinsic value of any stock on the market. Valuations based on purely numeric formulas don't work according to Graham because there's too much variability in the earnings an individual company earns, not to mention industry differences. Thus, ultimately, Benjamin Graham feels that the evaluations are a collection of human emotions with some basis of rough evaluation looking at the numbers being earned, where he says the stock market is a voting machine rather than a weighing machine. That's because in the short term, people are taking their votes with buying and selling. In the long term, the true value of the company will develop over time. Time shows everything. Mr. Market is just here to serve you the prices. What's the maximum limit he suggests for the price to earning ratios? At most, he says the PE ratio should only go as high as 20. Why? Because assuming that earnings stay the same and are treated as free cash flow to the shareholder, that would still be a 5% return. And this is treating it as if you truly did own the whole business when you're buying a stock. My small startup company I bought is only getting me 5% returns because I paid 20 times the earnings for it. Thank goodness I didn't pay more for it. And he says that the higher PE stocks are for speculative returns. He doesn't say it's a total mistake to invest with companies at high multiples. People can make money trading with these companies. However, people who habitually purchase common stocks at more than 20 times average earnings are likely to lose considerably more in the long run. Pick a good card and you'll have great returns. Pick a bad one and you'll lose more money in the long run. Not this card dealer again. I hate this guy. Of all the places to put this in the video, I felt this was the most appropriate for the enterprising investor. It is the Graham formula, which is not a magic formula. As we discussed earlier, there are no magic formulas. It is for rough estimates only at best. I'm not a financial advisor. Revisit the slides at the start of the video for disclaimers, where he gave a lot of warnings against using this as a metric of quantitative analysis. I'm just saying this all ahead of time, so we're all clear. Inside The Intelligent Investor, Benjamin Graham gave a formula to estimate stock value. It was Chapter 11, Security Analysis for the Lay Investor, and here it is. Value equals the trailing 12-month EPS times 8.5 plus 2G. Now that G is the expected annual growth rate for the next 7 to 10 years. And as mentioned earlier in the video, you have to have a range of approximate growth values based on the bull and bear cases. So try and get 2 different values if you really want to use this formula to get your estimates. However, I found out this was revised to a new formula years later, and as such, I'm going to include this as well in the video. The revised version is value equals the trailing 12-month EPS times 8.5 plus 2G times 4.4, and that's all bracketed and divided by Y, where G once again is the expected annual growth rate for the next 7 to 10 years, and Y equals the current yield on AAA rated corporate bonds. So just some dangers with this formula. The formula could be too aggressive with high growth stocks. Applying 2 times the expected 7 to 10 year growth rate might make the numbers higher than they should be for some really high growth stocks. And it could give a false sense of security to people if they see that big value number and then they see the current stock price and they think, wow, it's already 50% off. Not to mention, the world has changed a lot since the days that Benjamin Graham wrote this formula, even the revised version. And you'd be using past EPS data to estimate future results. On top of that, growth rates are additional estimates that could make value calculations incorrect. If you don't get the correct growth rate, that makes the evaluation obviously much different than if you used a smaller or higher growth rate from what it will be, since you don't know the future. So never forget the margin of safety mentioned earlier in the video. And I'd hate to hear some bad news when using Benjamin Graham's formula for advice, so I wanted to add these few cautionary flags out to people just to be sure. I know you're probably excited to use this formula, but just be careful and skeptical of the number that you find using it. Thank you so much for watching to the end of the episode. And if you're interested, consider joining with the Market Moves Investing Book Summaries link in the description down below.